Welcome back to Homebuyer University. Today we're going to be going over escrow accounts, aka impound accounts. What are they? How do they work? Where do they come from? What do you do with them?
After you close on your home and you start making your monthly mortgage payment, your mortgage payment is actually made up of your principal, your interest, your taxes, and your insurance. Now, every month when you go to write your mortgage payment, your principal and interest goes to pay back the bank. But how do we pay those other two, the insurance and the property tax? The other part of your payment is held in what we call an escrow or an impound account. Now, it is your money, but every month when you make that monthly mortgage payment, a piece of your payment goes into that escrow or impound account. Now, once your property taxes are due twice per year and your homeowner's insurance is due once per year, your escrow account is going to automatically send those payments off. So you might be thinking, what's the benefit of having an escrow account?
There is a pretty nice benefit of having an escrow account because it's less moving pieces and less of a what we'll call payment shock. Like Andrew said, your property taxes come due twice a year, which means those are two pretty large payments. They're usually due at the worst times. They come due like December end of year holiday party season and April tax season. And if you get hit with two big lump sum payments, that could make those days feel extra not good. So instead, paying a prorated amount on a monthly basis for the bank to hold makes it feel less terrible.
Now, what if I don't want the bank managing my money? Do I have to have an impound account?
I'm going to speak exclusively to California right now because that's where we are and that's what we know the best. In the state of California, you technically aren't required to have an impound/escrow account as long as you started your loan with more than 10% down. If you have more than 10% down, you have the option of having or waiving that impound or escrow account. So which would be the right fit for you? And let's break that down. Technically, the right financial decision is to waive that escrow account if you can, because you're essentially giving the money to the bank to hold to make interest off of. So instead, if you have the ability and you don't mind some lump sum payments, holding on to that money and making money off your own money is that better choice. However, if you just want less moving pieces, you want to set it and forget it, and you don't care about the minimal interest that you might be losing out on, an impound account might be the right move for you. For me, we have a couple properties. I have impound accounts on all of them, even though it's not technically the right financial choice because I don't like thinking about it.
So if the bank is holding my money, what happens if I were to sell or refinance my home?
Yeah, so it is your money held in that account. So if you were to sell your home or pay off your mortgage, if you run into a lump sum of cash or refinance, technically the bank gives you back that money. Unfortunately, those impound accounts typically don't transfer, and so it really just comes back to you. And then you have a choice of either setting a new one up or going the old-fashioned way and paying those bills directly yourself. So we just spouted a lot about escrow/impound accounts. Andrew, can you give us a quick recap?
So an escrow account is an account that collects your property taxes and your homeowner's insurance, and it makes those payments accordingly throughout the year for you. And in some cases, if you're in California and put more than 10% down, an escrow account can be optional. Just make sure you know yourself and that you're making the best decision for you.